Indexed Universal Life, often called IUL, combines permanent life insurance with a cash value that can earn index-linked interest. You're not investing directly in the stock market. The insurer credits interest using a formula tied to an index. With each premium, part of it pays insurance charges and part of it goes to cash value. Insurers may use financial instruments, such as options, to link crediting to an index. Caps, which are typically non-guaranteed and subject to change by the insurer, limit the upside you can be credited. Some policies include a floor that limits negative credited interest, though policy charges still apply. For example, if the cap is 12% and an index returns 15%, you're credited 12%. If the floor is 0% and the index is down 10%, the credited interest is 0%. IUL allows flexible premiums within policy limits, but you must keep enough value to cover charges or the policy can lapse. The death benefit may receive favorable tax treatment under current law depending on policy structure and individual circumstances. Flexibility is a strength, but it requires periodic reviews. And any increases in coverage could be subject to underwriting based on health and other factors. Cash value can build over time and may be eligible for loans and withdrawals. Loans will accrue interest. Loans and withdrawals may generate an income tax liability, reduce the account value and the death benefit, and may cause the policy to lapse. Sufficient premium and account value are necessary to cover insurance costs. Index returns do not guarantee that the policy will stay in force. There may be adverse tax implications for a policy classified as a modified endowment contract, or if the amount of your loans and/or partial surrender exceeds the cost basis of the policy. Distributions, including loans from a modified endowment contract, are taxable to the extent of the gain in the policy and may also be subject to 10% additional tax if the owner is under age 59 and a half. IUL policies may credit interest based on an index, subject to caps, floors, and policy charges. Funding flexibility and access to cash value are governed by policy provisions and conditions. IULs are more complex than term or traditional whole life. Charges and caps can limit growth, there are no dividends, and insufficient funding raises lapse risk. Loans carry interest. Investment choices are limited to the policy's index options. And while floors can prevent negative credited interest, long periods of low index performance and policy charges can reduce credited interest over time. Excessive funding may cause your policy to classified as a modified endowment contract. A policy classified as a modified endowment contract is subject to different tax rules, and tax treatment depends on policy structure and applicable law. Distributions are taxable to the extent of gain and may incur additional taxes depending on timing and status. Funding limits vary by policy and should be reviewed carefully. Premiums vary by age, health, coverage, rider, structure, and insurer. Expect administrative charges, surrender charges in early years, and loan interest if you borrow. If you're considering IUL, compare crediting methods, cap/floors, costs, and stress test funding with a licensed professional. Visit westernsouthern.com for more tips or call to discuss your options.